Back when I first began learning about investing, it wasn't long before I figured out the big secret of the stock market. And if you've found yourself to this video, it means you've probably figured it out too. Here's the secret. The stock market isn't perfectly efficient at pricing stocks. That's the secret that allowed Warren Buffett to become one of the richest people in the world, along with countless other investors that also figured it out. When I figured out this secret, as exciting as it was, I didn't have time to revel in the excitement because I had a new task in front of me. I had to learn how to value companies. I was glued to that computer, watching Warren Buffett and Charlie Munger videos, other videos I found online, and of course, reading tons of books. Finally, I figured it out. I now held on to what I felt was one of life's greatest secrets, and today, I'm gonna pass that secret on to you. The idea behind the discounted cash flows method is that the value of any cash generating asset is equal to the total sum of all the cash that it will be able to generate in the future, discounted back to its present value. Don't worry if that doesn't make sense yet, because by the end of this video, it's going to. The best way to explain is to dive into an example. Now imagine you're thinking of purchasing a business in your town and you're trying to figure out what it's worth. You look at the financial statements for the past 10 years and you come to the conclusion that, based on your conservative estimates, you think the company next year will generate about $100,000 worth of cash, and moving forward from there, cash flows should continue to grow by about 5%. To keep it simple, we're gonna go out 5 years. $100,000 the first year, $105,000 the second year, $110,250 in the third year, etc. So these are our future cash flows, and if we add them all up, we get a total of $552,563. Obviously, you wouldn't want to pay that much for this business though. Simply investing that money into an S&P 500 index fund would turn that $552,000 into roughly $811,000 after 5 years, if growing at a modest 8% per year. So to figure out what this business is worth, it's time to discount our future cash flows back to their present values. We've just established that we could earn an 8% annual return if we just put our money into an S&P 500 index fund. So that's the rate we're gonna be using for discounting for now, but we are gonna circle back to that discount rate decision later. This is the present value formula, but don't get overwhelmed if math scares you, because I promise you it's extremely simple. Present value is equal to cash flows divided by 1 plus the discount rate to the power of the number of years. Let's plug in the numbers and figure out the present value of our first year's cash flow. $100,000 of cash flow divided by 1 plus the discount rate of 8% to the power of 1, because it's the first year, equals a present value of $92,592.59. Now we're getting somewhere. Here's the second year. $105,000 cash flow divided by 1 plus the discount rate of 8% again, this time to the power of 2, because we're discounting it back 2 years, equals a present value of $90,020.58. The third year, $110,250 divided by 1 plus the discount rate to the power of 3 equals $87,520. And now I'll just fill in the rest. When we add up the present value of our future cash flows, we get $437,947.38. And there you have it. We just figured out what this business is worth to us. Now check this out, because this is a little gotcha that I want to explain. That number we just calculated, $437,947.38, growing by 8% per year, invested in an S&P 500 index fund, for example, would turn into $643,488.38 after 5 years. And if that's not the number you were expecting, here's why. The discounted cash flows value calculation assumes that the cash flows are reinvested at the same rate of return that we're discounting by. So it assumes that after the first year, when we collect our cash flows of $100,000, that we immediately reinvest that money in a way that will grow by 8% annually. The future value of that first year's cash flow we receive, another 4 years later growing by 8%, would be $136,048.90. That future value calculation is just $100,000 times 1 plus the 8% growth rate to the power of 4 equals $136,048.90. When we collect our $105,000 of cash flow after the second year and invest it to grow by 8% annually, we can calculate that the future value of it 3 years later would be $132,269.76. The future value of the third year's cash flow invested at 8% would be $128,595.60. The future value of the fourth year's cash flow invested at 8% would be $125,023.50. And for the fifth year's cash flow, we wouldn't do anything with it, because at that time, we'd already be at the end of our 5-year time span. So it would just remain as the $121,550.63. You guessed it, when we add up these future values, we get the same amount we said earlier, $643,488.38. Owning this business, which will generate these cash flows, and having $437,947.38 of cash right now are financial equivalents if you are using a discount rate of 8%. Another way to think about all this is that buying this business for $437,947.38 would be an investment that would provide you with an 8% annual return. That's assuming that you can reinvest the future cash flows to also earn 8%. And that's actually very cool what I just said there, so let me digress for a second because this is a very interesting point. So far we've determined that buying this business for $437,947.38 would give you an 8% annual return as long as you could also invest the cash flows at 8% as well. If you / the company can't find an investment for that cash that will earn 8%, and instead it ends up only getting invested where it will earn 5% annually, then your overall return won't end up being 8%. It will be less. Likewise, if you / the company are able to reinvest those future cash flows where you'll get 15% annual growth, then your overall return on investment from purchasing this business for $437,947.38 will ultimately end up being higher than 8%. On that note, check out this quote from Charlie Munger. Over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns. If the business earns 6% on capital over 40 years and you hold it for 40 years, you're not going to get much different than a 6% return, even if you originally buy it at a huge discount. Conversely, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you'll end up with a fine result. This is why I look for high returns on equity and especially high returns on invested capital as metrics that I like to see when I'm picking stocks to buy. And if you want to learn more about what I just said, check out this video right here. It's amazing. Now let's talk about the discount rate. So far, we've been using a discount rate of 8%. And you'll remember that the reason we used 8% as our discount rate was because we said that's what you could achieve by simply throwing your money into an S&P 500 index fund and forgetting about it. 8% is essentially our benchmark. However, if we changed our discount rate to 3%, it would instead make the present value of those future cash flows equate to $504,658.44. Or if we change our discount rate to 15%, it would make the present value of those future cash flows equal just $365,462.50. So which discount rate is the correct one to use? Great question. Remember at the beginning of all this, we said that the premise was that you're thinking of purchasing a business in your town and you're trying to figure out what it's worth. Let's now change the premise and instead say that the current owner has said that they're willing to sell for $450,000 and no less. Take it or leave it. And now, instead of your goal being to figure out what the company is worth, your goal is to figure out what annual return on investment you could expect if you purchase this business for that $450,000 price. To show you this next part, let's hop on the computer. Here's everything we've been talking about so far. We've got the discount rate here. Here we've got the cash flows, their present value, the sum of all the present values added together. This line is the future value of the cash flows if invested at 8% until the end of the 5 years. And this is the sum of those future values. Remember we said that this number here, growing by 8% per year for 5 years, would become this number here. So that's where we left off. Remember the present value formula we looked at earlier? It has 4 variables: present value, future cash flows, discount rate, and number of years. Cash flows is a known variable in the sense that we've estimated what they'll be. Number of years is also a known variable. We've been working with 5 years in this example. Now, typically, since we're solving for present value, we need to just make up what discount rate to use. In our example, we used 8%. But since this time price is already set, $450,000, take it or leave it, it means that we can actually rearrange this formula to now instead solve for the discount rate. Once rearranged, the formula looks like this. If we plug in our numbers, we get $643,488.38 divided by the present value of $450,000. The result of that to the power of 1 over 5, because 5 is the number of years we've been talking about here throughout this video, and then subtract 1. I'm gonna actually do this now in the spreadsheet, but I want you to know that I'm doing this the long way so you understand what's going on when I show you the tool that this entire video has been leading up to in just a second. So here goes, 7.42%. Interesting. If I plug this 7.42% into our discount rate field right here, which will update all of these numbers over here, I want you to notice what happens to our present value calculation and also our discount rate calculation. Okay, I'm gonna copy and paste it and hit enter now. Our present value calculation has come closer to the $450,000 amount, and our calculation for the discount rate has also changed. Let's copy and paste this once more. Copy, paste, enter. Again, the present value calculation has come closer to that $450,000 amount. And our calculation for the discount rate has also changed. Now, I could keep doing this over and over until these numbers matched up perfectly. Thankfully, there's an easier way. Introducing the IRR formula. IRR is short for internal rate of return. To use it, we simply add the cash outflow amount of $450,000 right here as a negative number because this is the price we would be paying for this business. So it's an outflow of cash. And then we type equals IRR and then highlight all the cash outflows and inflows. And ta-da! The resulting number is the discount rate that we just tediously solved for. Now, what does all this mean? Well, it means that purchasing this business for $450,000, as long as those cash flows can be reinvested at that same rate of return, would be an investment that has an expected annual return of 7.011592%. Now, in the real world, getting to this level of precision would be ridiculous because estimating future cash will always be an estimate, and estimating what rate the future cash flows will be able to be reinvested at will also always be an estimate. And that's why also in the real world, us value investors use conservative estimates for the future as a way of giving ourselves a margin of safety. This video here is one I did in the past for Apple stock. It's a very similar video to this one. You're gonna enjoy that as well if you want to check that out. But before you watch that one, I would actually suggest watching this one right here on earnings per share versus free cash flow versus owner earnings. Tom says, I wish I saw this video 10 years ago. This is explained perfectly. Dan says, the difference in financial statements was crazy. Good info in the video as always. Claire says, thanks for explaining owner earnings in an easier way. A really helpful video. Wall Street Bets Copycat says, God, I love this channel. And Gayula says, great video, Richard. I've learned a lot. Now I know the difference between free cash flow and owner earnings. Well explained.